Celtic Capital President and CEO Mark Hafner and Alex Fallow, Executive Vice President and Chief Credit Officer, present an explanation of financial covenants and how they affect a business.
So there are a few different types of covenants in loan agreements, whether it be a bank or an asset-based lender or what have you. The first is an affirmative covenant, and those are that the borrower is attesting that they will do certain things. The next is negative covenants, where the borrower is attesting they will not do certain things. And the last, which we're going to focus on today, are the financial covenants. The financial covenants are typically in loan agreements with banks and some larger asset-based lenders because they are trying to control the financial outcomes of the business and manage their credit risk by having these covenants in place so they can monitor how the business is doing. So a couple of the more common covenants that you'll see in loan agreements is interest coverage ratio, and that was typically you take your bottom line net income, add back interest expense, add back depreciation, add back your taxes, you get your EBITDA as they call it, and you're comparing that to your cost of interest. So the lender's goal here is to determine, do you have enough free cash flow to be making their interest payments? And usually lenders will want to see a ratio of 1.25 or higher to meet the covenant. The next covenant that is common is debt to worth, and your worth is the equity of the business, but lenders will typically look at the tangible worth of the business, and so they take your equity, they add in any debt that's subordinated to the lender, and they subtract any intangible like a goodwill, that type of thing, and typically prepaid expenses. That gives them their tangible net worth. They compare that with the debt, and they want to see a ratio. Usually banks will want to see a tangible net worth or a debt to tangible net worth of 4-to-1, maybe 5-to-1. Asset-based lenders may be a little higher. Those are important to look at because you may have to manage your business to meet those covenants. Some lenders, like a Celtic Capital, don't have financial covenants, so we allow more flexibility with the borrowers, and they don't have to tightly manage. A lot of our borrowers are owner-operators, so the owners of the business are operating those companies, and it gives them more flexibility to do what they want. If they're making money, they can take it out, they can pay themselves higher salaries, that type of thing. So we're not as concerned with the covenants as we are with the performance of the collateral that we're financing.
Yeah, Mark, and further to that point, I think it's important that potential borrowers who have individuals as owner-operators typically like to run their companies as lifestyle companies, and they'll take out all the earnings for potentially tax distributions and or salary. And if you try to do that as a bank, you'll trip a covenant almost immediately. So I think that's one of the most important things to remember, that as a borrower with an asset-based lender versus a bank, you have much more flexibility in what to do with your balance sheet than with a bank.
Good points. If you're with a bank or another lender that has financial covenants and you violate them, that's a default of your loan agreement, and the bank then has various remedies they can impose. It could be higher interest rates, some fees. It could be they call the loan if it's significant enough and they want payback of the loan immediately or ask you to find another lender to take them out. There can be some serious repercussions if you trip those covenants, so it's very important to manage those closely.
Thank you for listening today. If you'd like to talk to Mark Hafner about your specific business financing issue or about making referrals to Celtic Capital, sign up for a quick one-on-one chat with him at www.celticcapital.com. And if you haven't already done so, subscribe to our podcast channel to hear more business financing insights from Celtic Capital.